Welcome to The Explainer. You know, the stock market sounds absolutely incredible, right up until people start throwing around words like PE ratio, dividends, and trailing stops, right? If you've ever felt completely lost in all that financial jargon, trust me, you are definitely not alone. But today, we're going to decode that alphabet soup of investing together. By the time we wrap up this explainer, you'll be ready to invest with total confidence, zero confusion. Let's get into it.
Okay, so here's our roadmap for today. We're going to hit the stock market basics, look at types of investments, figure out analyzing and valuing stocks, talk about actually making the trade, dive into market moods and strategies, and finally, wrap it all up with managing your risk.
All right, let's kick things off with part one, the stock market basics.
So when you buy a stock, or what folks sometimes call equity, you're not just buying some random numbers on a screen. You're actually becoming a part owner in a real living business. I mean, think about it. If you own one single share of Apple, you are literally a part owner of Apple. Pretty cool, right? You buy these shares on a stock exchange, which is basically like Amazon, but instead of buying books or blenders, you're buying pieces of companies. And to find these companies super fast, we use short codes called ticker symbols. So Apple, for example, is just AAPL.
Now, this brings us to a massive distinction: public versus private companies. Public companies, like your Apples or Amazons, they have wide open doors. Anybody can buy into them on the open market. But because of that, they have to play by really strict rules and show everyone their financial report cards. Private companies, on the other hand, well, they're locked down to a small, exclusive group of investors. You can't just hop online and buy a share of SpaceX or IKEA, right? Because they're privately held.
Moving right along to part two, types of investments.
So once you decide to invest, you've actually got to choose what kind of ownership you want. Usually when people are talking about stocks, they mean common stock. This is the one that gives you a slice of the profits and actual voting rights on the company's big decisions. But hey, there's also something called preferred stock. With preferred shares, you're usually giving up your voting rights, but in exchange, you get a fixed dividend payment. It's kind of like this hybrid blend between a stock and a bond. Plus, and this is a big plus, if the company goes bankrupt, preferred shareholders are actually in line to get paid back before common shareholders.
Now you might be thinking, what if I literally don't want to pick individual stocks? Well, you don't have to. You can actually buy into huge chunks of the market all at once using major indices. The S&P 500, for instance, tracks 500 of the biggest U.S. companies. It's an awesome benchmark for the whole economy. Then you've got the Dow Jones, which zeroes in on just 30 massive established giants like Boeing. More into tech, you'd look at the Nasdaq Composite, tracking over 3,000 tech-heavy companies. And if you want a pulse on up-and-coming small businesses, you'd watch the Russell 2000. Using index funds, you can actually invest in these entire lists with just one single purchase, a total game changer.
Okay, let's jump into part three, analyzing and valuing stocks. When it comes to figuring out what a stock is actually worth, there are two totally different schools of thought. First, you've got fundamental analysis. This is for the folks who really want to roll up their sleeves and dig into the raw business data. You know, the revenue, the debt, the profit, trying to find the company's true intrinsic value. And then there's technical analysis. These investors, they don't necessarily care what the company actually makes or sells. They are laser-focused on reading price charts, spotting momentum trends, and finding price floors and ceilings, what they call support and resistance levels.
Now, if you're leaning toward that fundamental approach, it helps to picture a company's finances kind of like a giant funnel. Up at the very top, you pour in the raw fuel, the revenue. A business might make billions in revenue, but wait, you got to subtract all the expenses on the way down. The taxes, the salaries, the rent, all of it. What finally drips out at the very bottom? That's the net income, famously known as the bottom line, and it is the ultimate measure of a company's true profitability. So what's really cool is we can take that bottom line net income and use it to figure out some seriously powerful ratios. First up, EPS. That tells you how much profit a company makes for every single share of stock. Take that EPS, compare it to the actual stock price, and boom, you get the PE ratio. A super low PE might mean you found an undervalued bargain, but a really high PE, that could mean the stock is dangerously overvalued. We even have the PEG ratio, which factors in future growth, and book value, which basically says, hey, what would this company be worth conservatively if they sold off every single asset they own tomorrow morning?
All right, you've done the math. Part four, making the trade. When you finally go to hit that buy button, you've got to make a choice. Do you want speed or do you want control? If you want speed, you go with a market order. That just tells your broker, hey, buy this stock right this second at whatever the best price is right now. It's incredibly fast, but the price might bounce around a bit. If you want control, though, you use a limit order. This lets you set the exact maximum price you're willing to pay.
So, say Apple is at $190, but you only want to pay $185. Your limit order just patiently waits until the price drops to exactly $185 before pulling the trigger. But hey, you probably don't want to sit staring at a computer screen all day watching prices, right? That's where advance orders come in to automate your life. A stop order is basically your safety net. If a stock unexpectedly plummets, it automatically sells at a trigger price to cap your losses. A trailing stop is even smarter. It's like a shadow that follows your stock upward as it rises, locking in those profits if the price suddenly reverses. Then there's fill or kill, mostly used by big institutions that need a massive trade done entirely and instantly, or not at all. And good till canceled orders, which just stay open for days or weeks until your exact target price is finally met.
Now, for the really aggressive traders out there, did you know you can actually make money when a stock goes down? It's called short selling. Basically, you borrow shares you don't even own and immediately sell them, betting that the price is going to crash. If it does crash, you buy those shares back at that new, much cheaper price, which is called buying the cover. You return the shares to the lender, and you pocket the difference. But a huge word of warning here. This carries potentially unlimited risk, because if the stock price goes up instead of down, well, there is no ceiling to how high it can go. You could be forced to buy it back at an absolutely massive loss. So tread carefully.
Moving right along to part 5, market moods and strategies.
You know, the market isn't just a bunch of numbers. It's heavily driven by human emotion, and these shifting moods are best captured by two very different animals. A bull market means prices are rising, the economy is booming, and investors are super optimistic. Just picture a bull thrusting its horns upward. A bear market, that is the exact opposite. Prices are tumbling, fear is everywhere, and it gets its name from the way a bear swipes its heavy paws downward.
So, how do you actually know if you're in a real bear market? Well, officially, prices have to drop by a severe 20% or more from their recent highs. If the market only drops, say, around 10%, take a breath. That's just considered a healthy market correction, just a temporary pullback that cools off overinflated prices before things start climbing again.
Your strategy during all these market swings really depends on your personal timeline. Day traders, they're operating in minutes and hours, buying and selling frantically before the closing bell. Swing traders hold on for days or weeks, just trying to catch that medium-term momentum. Position traders zoom out even further, holding for months to ride broader trends. And then you have your long-term investors, think Warren Buffett style, who take a buy-and-hold approach over years or even decades, totally ignoring the daily noise to just focus on compounding growth.
And finally, we arrive at part 6, managing your risk. Look, investing takes serious discipline because emotional traps are literally everywhere. First up is FOMO, the fear of missing out. It'll trick you into buying skyrocketing stocks at their absolute peak just because your neighbor did. Then you've got pump and dump schemes. That's when manipulators hype up some low-price stock with totally fake news just to sell their own shares at the top, leaving you holding a worthless bag. And market bubbles, like the dot-com boom or the 2008 housing crash, those happen when prices inflate way above actual value based purely on speculation. And trust me, bubbles always pop eventually.
Speaking of traps, one of the biggest is misunderstanding the double-edged sword of margin. Having a margin account means you're borrowing money from your broker to buy way more stock than your cash would normally allow. We call this leverage. Now, leverage can absolutely magnify your gains when you guess right, but if the market moves against you, oh boy, your losses are going to multiply just as fast, potentially wiping you out completely. So, to protect yourself from all this craziness, you absolutely must follow the golden rule of investing: diversification. Simply put, do not put all your eggs in one basket. By spreading your money out across different asset classes, mixing volatile stocks with nice stable bonds, throwing in some bundled ETFs, maybe earning some dividends through real estate investment trusts or REITs, you basically ensure that one nasty drop in a single sector isn't going to completely wipe out your entire portfolio. Well, there we have it. We've successfully decoded the jargon and laid out all the essential building blocks. You now officially speak the language of the stock market. So I guess the only question left for you is this: how are you going to use these new tools to start building your own investing journey today?